Hello everybody, my name is Andre Kwan from PrimeLending. I get asked all the time, like, what is a doctor loan and what is a doctor loan compared to a conventional loan? And it's an interesting point because we have a lot of friends that are graduating from grad school and trying to figure out, is this the right time to buy a home or not? How do I buy a home? How to come up with a down payment? So I'll go over some of the differences today, and hopefully we can find a fit of what program works best for you. So typically any loan program, whether it be a doctor loan or a conventional loan or a government loan, they will have three criteria that they follow. What is the credit, what is the income, and what is the collateral, meaning what is the money available for down payment or reserves. So we'll just kind of go over that one by one. In terms of credit, either programs, they're going to typically want to have better credit scores, somewhere above the neighborhood of 720 or higher for your credit scores. That's required for a doctor loan. Some other programs may have a little bit less requirement. It's all a matter of whether it be a conventional or government loan. They can go as low as 580 sometimes, believe it or not. Next up, we have income. Income is kind of like the next level for these programs and how they are perceived. So for doctors and physician and preferred medical program loans, income can be based off of truly what your contract is, or if you're in grad school about to graduate and you have income lined up with a new firm or doctor or hospital, they can use advanced income as well. That is not always the case for conventional or government loans. Typically they will want to see that you're on your job for a period of time before they'll allow you to use that income. And then finally, that gets us to the last kind of frontier, which is collateral. For down payment plus assets, for a physician's loan, believe it or not, you can go all the way up to $1 million loan amount with as little as 5% down payment. And then also with no mortgage insurance. And typically for the reserves, they're going to see that you have at least typically 6 to 9 months worth of those payments saved up. And so that differs a little bit for the conventional loan. For typically most investors, when you pass over a certain dollar amount, so like here in San Diego, when you pass over $729,000, they'll consider that loan a jumbo loan. Most investors are going to want somewhere between 20% down payment. These specific and special kind of loans for physicians and medical professionals, they can come in with as little as 5%. So that makes a huge difference. If you're talking about $1 million purchase price, the preferred medical professional program, you come in with as little as $50,000 versus having to come in with $200,000 down. So there are slight differences for this. There are different investors that they do them in different underwriting styles. For your best shot, you're typically going to want to meet with a service provider or mortgage professional that has experience with this. We have multiple investors that can provide that for you. So please, when you have the opportunity, please ask us some more questions. We'd love to teach you some more and check out what the difference is between preferred medical professional programs and your conventional programs out there. Have a great day.